Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back. I'm Domenic Rinaldi, host of the M&A Unplugged podcast. And we've got some great news. It looks like the CARES Act is going to have a round two. And this is particularly important because there's an SBA component that is going to extend a lot of the benefits that were offered last year for SBA 5A business acquisition loans. And they've even sweetened the pot. So today I brought back Doug Adams of Emerson Capital to talk about some of these changes. They haven't been finalized, but in all of the discussions that we're having with the bankers and the SBA, it looks like this will happen. And there's some really big changes, some positive news, some great benefits, not just for buyers, making it cheaper for buyers to secure and easier for buyers to secure SBA 5A loans for business acquisitions, but I also believe strongly this is going to be great news for sellers. Sellers are going to be able to more easily attract buyers to their businesses. Buyers are going to be able to cash more sellers out because they're going to be able to leverage banking. So I really think this is awesome news, should continue to stimulate both the economy and the M&A sector, this year and maybe beyond. So some big changes, lots to offer here in this episode. I hope you enjoy our podcast. If so, please take a moment to subscribe and review our show. We really appreciate it. And by subscribing, you'll be notified of new episodes and the bonus episodes we plan to release in the near future. In the meantime, if you have any questions about buying or selling a business or need to better understand the process, don't hesitate to reach out to me directly at drinaldi@sunacquisitions.com. I am committed to helping you avoid the common pitfalls so you can maximize value and minimize risks. Thank you for being here, and I know you're going to get a ton out of today's episode. Hey, Doug, welcome back to M&A Unplugged.
Thank you, Domenic. Happy to be here.
Well, listen, Happy New Year. And what a way to kick off the new year with this news coming out of the SBA about some changes that they're going to make to SBA lending in the new year. And it's really sort of a continuation of what started last year with the CARES Act, but they're taking it to another level now. And I think this is really great news for buyers, and it's really good news for sellers too, because if buyers can more readily get access to lending, it means that sellers are going to be able to walk away with more money at the closing table potentially.
There's no doubt. This latest stimulus package is really designed to do just that: stimulate the economy, encourage the banks to lend, and make it easier and more effective to keep businesses doing what they want to do, encourage more acquisitions, encourage more lending. And so there's a number of things that they've put into place now, some of which we've had in place before and it's lapsed, and some new stuff, which is really exciting for all of us who are involved in financing acquisitions and doing SBA loans.
Yeah, absolutely. So yeah, we just completed an interview at the end of last year, and but when we heard this news, I said, we've got to get Doug back and let's dive in. So let's do that. So I should say, though, that these changes have not been approved, but they're looking likely. So that's the one disclaimer that we'll put on this discussion. So Doug, let's dive in. What are some of the changes?
Yeah, so you are absolutely right. The bill was signed about 9 days ago, I think it was. Technically, there's 10 days for the SBA to digest and make official whatever changes that they're going to implement. So today is actually the 10th day. So we are expecting that this will be finalized today. Maybe it'll be Monday, but we have a pretty good idea what they're going to do. First and foremost, one of the most exciting things about this is that they are going to be waiving the SBA fee for all newly booked deals. Now, the program has always had this fee. It's a sliding scale, 2.5 to 3.5 times 75% of the loan amount. But in order to encourage more lending and stimulate growth, they're going to be waiving this fee. So starting February 1st, again, these are not definitive, but this is what we're being told, and this is what's come out in the memo. Starting February 1st and going through September 30th, all the banks will be waiving the SBA fee on every newly booked deal. This is significant, depending on the size of your deal. For example, if you are going to have a loan on that's going to be $1 million loan, the fee is $26,000. If you have a $5 million loan, that fee is $138,000.
Wow.
So, everything in between, $3 million is about $82,000 fee. So, obviously this is significant for every buyer who is booking a deal. And it's exciting. We had, and I think you and I talked about before in 2020, in the first CARES Act, some of these features that have now being re-implemented, but this was not one of them. This is a new feature, and I think it's going to be dynamite for everybody involved.
Yeah, look, those are significant dollars, and we should tell the audience that traditionally and historically, those SBA fees get rolled into the loan package. So you're paying for those over, whatever period of time. I mean, you can pay for them up front, but typically they go into the loan package. So imagine if you're saving somewhere between $25,000, $50,000, and $150,000 in fees. That's pretty substantial over the life of a loan.
There's no question, and I'm glad you pointed that out. Yes, they get bundled into what is known as the project cost. So in an acquisition, the project cost consists of the purchase price of the business, the SBA fee, and then the bank's closing costs, which may run about $10,000. So you don't have to pay that $82,000 or that $130,000 out of pocket. You're going to pay your equity injection in the deal structure, which typically is 10% of the project cost. So while if your $100,000 fee is part of the project cost, you're going to pay $10,000 of it as part of your equity injection.
Yeah,
it's still savings over the long term, and most people are pretty happy about that.
Yeah.
But we don't want to mislead anybody to think they've got to come out of pocket $80,000 or $60,000. Right. So you're correct.
Well, that's substantial. I mean, I think buyers are going to hear that, and they're going to flood to the SBA and lenders and brokers like you to try to get deals done, because that's a big savings.
I think it is too. And there's another huge stimulus part to this, and that is that the SBA has agreed to re-implement. This is something they had in 2020 but lapsed, and now they're starting it again, starting February 1st and going through September. And that is that the SBA will actually pay 6 months of principal and interest payments for any newly booked deal from February through September. It's capped this time around at $9,000 a month. There was no cap last time. But so, if it's 6 months of payments and it's capped at $9,000, it's $54,000 additional that you will not have to pay those payments. And if they're not deferring the payments, they're actually making them for you. So, it's not any kind of debt or anything like that. And additionally, this time around, which is different from last time, that those payments being made are not going to be taxable in any way. So it's not like you have to pay income tax on that benefit of that revenue.
Wow.
For that reduction.
That's incredible. So did you run any numbers? Do you know what a typical loan size is for about a $9,000 a month payment, principal and interest?
I did not. I can. I mean,
that's okay. Look, it depends on the interest rates and all that sort of stuff, but that's a sizable amount. It's going to be a pretty good size loan to have $9,000 a month over 6 months.
So if you think about it, every newly booked deal of let's say $2 million or more is going to save $54,000 in payments, and let's call it $50,000 of SBA fee.
Yeah.
So you're ahead by $100,000 or more, depending on the size of the loan.
Yeah. That's a big deal. Money people can put in their pockets, throw into the business, lots of things that you can do with that. And like I said, I mean, buyers are going to get a massive benefit here, but I also think sellers are going to be the benefactors as well, because SBA is making it easy for buyers to secure these loans now. And I think sellers are going to really benefit from that.
Well, and on that point too, I'll mention another one of the benefits that have come out, and that is that the program, and again, these are all, we don't know for sure, but this is what we believe is going to be the case. The SBA it guarantees the banks on these deals, and that's one of the reasons these banks do all these deals with absorbing all this goodwill and just being about cash flow and not collateral. And historically, the government, the SBA, has guaranteed the banks 75% of their loan exposure. That is now being raised from February 1st through September to 90%. So now all these banks have a 90% guarantee on every newly booked SBA loan. So that's only going to encourage them to do more. And if they're ever on a fence on a deal, whether they're going to approve it or not, that hopefully would push them over and accept that risk.
Yeah, and we should maybe some points of clarification. For folks who are going through this for the first time, the SBA is not the direct lender, right? The SBA guarantees the loans. You still have to go to the local banks that do SBA loans to process the loans. The SBA is only the mechanism standing behind the guarantees for those banks.
Yeah, that's correct. The lender is the bank. You're the borrower. You're borrowing money from the bank. Everything is done through the bank. I only work with preferred SBA lenders, which are the banks that can make these decisions and service and do the deals all in-house. But the SBA is the guarantor to a certain extent. But there still are the underwriting process with the banks. They still have to look at the cash flow. They still got to make sure it makes sense and service the loans.
Yeah, and I think you bring up a really important point. You only work with preferred lenders, which means those banks can make the decisions, as you stated, internally. They never need to go to the SBA for approval. And then there are non-preferred, but those banks actually have to process through the SBA, which adds time, and the file needs to get sent to the SBA office, I think out in California, right? So you could add a pretty significant amount of time for those non-preferred lenders.
That's correct. The preferred lenders will go and get what they call a PLP letter PLP number to assign to each loan. So they're notifying the SBA of each deal they're doing, and the SBA will come in periodically and audit their books and make sure that they're doing these things according to the rules and regulations that they are supposed to be doing to perfect that guarantee. But they can do it all internally, like you said.
Yeah. And another reminder for everybody that these loans are typically amortized over 10 years. Minimum could be longer if you package in real estate, right? You could get a blended amortization that could go above 10 years. But the amortization on these loans and the interest rates are really tremendous. What are we running right now, Doug, for interest rates? Roughly?
So on the 10-year deals, we are generally speaking, the highest that any bank is going to be able to lend because of the SBA rules is 2.75 over prime. So that puts you at 6% today. Many of the banks are a bit lower, and I think the range you're going to see typically is between 5 and 6%. That's going to be the 10-year loans, no prepayment penalty. And it really works out well. If you are getting a longer loan because you have real estate involved, depending on the value of the real estate compared to the value of the business that you're buying with it, it will dictate the length of the term. And if the real estate accounts for half the deal or 50% of the total project, then you will get a 25-year amortization for everything, wow, which is wonderful. Those longer deals, or the deals that are over 14 or 15 years, have a bit of a prepayment penalty in the first 3 years, which is kind of normal, but it's 3 years, so it's not the end of the world. But otherwise, there's no prepayment penalty.
Got it. And another reminder to the audience is these loans are capped at $5 million for the most part. There are some banks out there that will get over $5 million, but generally speaking, loans of $5 million doesn't mean the purchase price of the business has to be $5 million, just that the loan is $5 million. If you want to put in extra equity, you're buying a $6.5 million business, you can do that, but the loan value is capped at 5.
That's correct. The 7A loan, or 504 for that matter, but if 7A loans is the vehicle that we normally use. So if you're buying a $6 million purchase price business, you're going to put 10% in. Maybe there's a 10% seller note historically with the SBA fee involved, but without it, now you're going to end up around 4.9 million on your loan. So you come under that 5 million exposure threshold. Yeah. As you and I have talked about, there are banks now that are lending above this amount, using SBA loans in conjunction with a conventional loan or subordinated debt. Some banks do it on their own, some will farm it out. And in those cases, you may have a combined conventional loan along with the SBA loan. Then, so you may be doing a $10 million purchase price deal. You have your 10% down from the buyer, maybe 10% from the seller. Maybe you have a $3 million subordinated loan within the bank, and then the $5 million SBA. Processed all together and, along the terms that the normal SBA deals would be done, but it allows you to go a little bit higher.
Yeah, yeah.
And I will say this in conjunction with that, we didn't talk about this yet, but one of the other benefits that now is coming out are the lines of credit. The SBA historically has offered the banks the guarantee for the banks to do an express line of credit. These are unmonitored lines of credit. And historically there was
Explain what unmonitored means, Doug.
So if it's monitored, which you see in a lot of conventional loans, they're going to ask you to send in monthly reports or bi-monthly reports of your accounts receivable or your inventory. And then they're going to lend a percentage of that. So if you've got, $1 million worth of receivables, they may lend you 80%, up to 80% on that, utilizing the funds from your line of credit. The nice thing about the unmonitored is that you basically use those lines of credit as you see fit. So historically, those unmonitored express lines of credit, which we put in conjunction with the SBA 7A loan acquisition loans many times, was $350,000 cap. That was raised to $1 million with the last CARES Act of 2020, stopped at the end of the calendar year. They've now reinstituted that again with this batch. And so it's back up to $1 million, which is a wonderful thing for everybody involved. And that goes through September. And then at the end of September, it'll come back down. However, it's going to come back down to 500 and stay there, not go back down to the 350. And on these, there's also a little bit of things happening in the background where the bank is getting an increased guarantee on the lines of credit. Doesn't really affect the borrower much, but historically, it's been a 50% guarantee on lines of credit, compared to the 75% on the 7A loans. That's going up to 75% for the banks for this period, capped at $350,000, which gets a little confusing. But there are situations where they're going to get more of a guarantee on the lines of credit.
Yeah, and I think this is so important, Doug, because one of the biggest stumbling blocks and challenges for people moving into a new business is lack of proper working capital. And now the SBA is making it easy for you to get access to the working capital, get access to more of it. And something that really, I think buyers should spend more time on in their diligence, really understanding what that business is going to need until they're in a cash flow positive position. And you also, have to have some dry powder in case there's a hiccup in the economy. And so I think this is so important. And I think a really big change and a positive change.
I think it's a great thing. And we're already seeing many banks utilizing it and doing these lines of credit much larger than $350,000. And I will say that the banks also have the capacity of putting working capital into the deal structure in addition to, or instead of, if you prefer for some reason, to have your working capital that way, which is available to you the day after you close the loan, which is fine as well. It'll raise your equity injection requirement a little bit, which is why the lines of credit are a little bit more attractive. Plus, once you take those funds out, they start amortizing into the balance of the loan. You can't borrow it, pay it back, and reborrow it like you can with the line of credit.
Right, right. And so it just goes into the loan amount and gets amortized, and you're paying it off over that 10-year period, whatever
Yeah,
amount.
and whether and if you don't use it, it doesn't, you don't pay
Doesn't
for
add.
it. But
Yeah.
once you do, it's part of the package.
Well, Doug, these are really very positive changes. Great way to start off the new year. And I know as we started the episode off, we're waiting for final approval, but hopefully that is just a day or two away, and then and we'll be able to start implementing this. As we close up here today, Doug, any other overall comments about lending, the market in general, what you're seeing from the banks, what they're saying?
Yeah, so the banks are still lending, as they have, throughout this COVID environment. They're looking closely at the 2020 numbers, as they always do. But so as you and I have talked about many times, many of these numbers are down with the number of businesses. And how are they reacting? How are the underwriters treating those deals? Are they still willing to understand them? And if you have a business that was down in March and April and May of 2020, but has rebounded now and has stabilized at some number, then the banks will take that into account, and they will get on board with the fact that this was a sort of a one-time thing associated with the lockdowns and that kind of situation, and will focus on what they're doing the last 3 or 4 months, as long as it's similar to what they did prior to the beginning of the COVID.
So if the business shows that it's rebounded to pre-COVID levels or close to pre-COVID levels, the banks are getting confidence and they'll move forward.
Yeah. As long as the coverage is still there.
Right.
They still want to make sure that they've got debt coverage. They're not going to go into a situation where it's the business is not throwing off enough cash to make the debt payments. But if it is, then they will try to get those deals done. Yeah.
And have there been any changes to the debt service ratios one way or another?
Not that I know of. That's a pretty stable thing. They want a minimum of a 1.15 coverage after allowing for a buyer's household cash flow needs. But the reality is that most banks want something north of a 1.2 or 1.25 coverage, just so they got a little bit of a cushion.
And can you just describe debt service coverage so folks are clear about that who haven't been through this before?
Right. So the banks are going to take the existing cash flow from the business, the historical cash flow from the business you're going to buy, and they're going to, if absent of outside continuing income from the buyer, they're going to slice off a piece of it for what is perceived as the buyer's household cash flow needs. From what's left, they're going to compare that amount of cash flow to the debt service going forward. So they're going to superimpose the SBA loan, the seller note payments, if there is a seller note, as well as fully utilized line of credit, interest only on the line of credit. And those components will make up the debt load going forward. And then if you compare the cash flow to the debt load, that's where you're seeing those ratios. So you have to have at least I would say a 1.2 or higher to be safe in this environment.
Of cash flow, or what we call adjusted EBITDA or seller discretionary earnings, has to be 1.25, whatever that debt service is.
Above the debt service, and also allowing for the household cash flow needs.
Right. Well, that's great, Doug. I imagine you're going to be very busy here. If folks need if folks need to get in touch with you, how could they reach you?
So they can always call me. I've got my phone with me all the time. It's 773-368-9611, or email me at dadams@emersoncapitalcorp.com.
Yeah, and I'll just add in closing that I know you do a great job for buyers. Your fees are paid by the bank, so it never comes out of the buyers, but your ability to package up a deal and help the buyer through the process is incredible. You're detail-oriented, and I would highly recommend that anybody give you a shout, because you're in good hands.
Well, I appreciate that. Thank you, Domenic.
All right, Doug, thanks for coming on again.
Okay, thanks for having me. Take care.
Take care. I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.